January, April, July, and October. These are the 4 months when most business news channels are occupied in discussions about the performance of companies in the form of quarterly reports. Now, what are these quarterly reports? These are reports that state the key financials of a company in that particular quarter. These reports help an investor analyze a company and in general manage their investments better. So, if the quarterly results are poor, for instance, if the investors through reading the quarterly reports realize that the demand is facing a slowdown and that this slowdown could be structural in nature, in other words, that this slowdown in demand is long-term in nature, then these investors may want to exit the stock. On the other hand, if the quarterly results are extremely positive, if the sales are increasing and with an increase in sales, the costs are remaining controlled and the profit margins are increasing as well, then these investors may also want to enter or accumulate the stock. Now, when we look at quarterly results, it is equally important to look at two other documents. The first is investor presentation and the second is the earnings call transcript. Now, what is the investor presentation? This is basically a presentation by the management in which the management discusses the operations of the company in that particular quarter, the financial results of that company in that particular quarter, comparing with the previous quarter as well as the same quarter of the previous year. And the management also discusses the future outlook of the company. In earnings call transcript, it's basically a Q&A between the management on one side and analysts and investors on the other side. Now, before we look at these two other documents, let's discuss the components of the quarterly report first. Now, the first component of an earnings report is top line growth. Now, what do we mean by top line? It means gross revenues or the total income of a company. Now, the total income of a company can be divided, or the revenues of a company can be divided into two parts. First is the revenue from core operations and the other is the other income. Now, by revenue from core operations, we mean revenue that the company generates from the core operations. So, for instance, if we are talking about Tata Motors, then the core operations of Tata Motors is the manufacturing and selling of passenger and commercial vehicles. So, that is the revenue from core operations. And the second is other income. By other income, what we mean is a company generates cash through the core operations and that cash is generally invested into, let's say, mutual funds or government bonds, government securities or short-term investments. When the company invests this cash in short-term securities, it also gets dividends or interest from that investment. And this dividend and interest is not part of the core operations of the company. The company is receiving this income not from the core operations, but from investing the cash that is received from core operations. So that is other income. So now to understand the top line growth, let's take an example of Dr. Lal PathLab. If we look at the quarterly results of Dr. Lal PathLab, specifically the quarter ended September 2021. So from 3 months, June, July and September, we realized that the total revenue of the company decreased by a staggering 17.4%. Now, a question that may arise is why did it decrease by 17.4% suddenly and by such a huge percentage? To understand that, it may help to look at that quarter's earnings call transcript, which you'll be able to find on the company's website. So let's take a look at that. So on Dr. Lal PathLab earnings call transcript dated October 27, 2021, on page number 4, the managing director, Dr. Om Manchanda, he discusses this. We experienced a sharp decline in COVID and COVID-allied tests when COVID wave receded starting in June month itself. The decline in revenue is contributed by lower realization per test. So essentially what happened is there was a second wave of coronavirus going on in India in the month of April, May and June. And there was lockdown and there was a rise in COVID test which contributed to increased revenue for the company. The realization, the revenues per test was also high during then. But after June, so July, August, September, what happened is the second wave receded and suddenly the diagnostic companies faced a pressure on their revenue. The COVID revenues declined. On page 5, the management says that the contribution of COVID portfolio in the overall revenue declined to 10% in that particular quarter as against 36% in the previous quarter. So from a contribution of 36% to a contribution of only 10% of revenue. That is a huge drop in COVID revenues for the company. And not surprisingly, the stock price of most diagnostic chains have been falling since then. So next, let's take a look at the operating profit and the operating profit margin of the company. Now, first of all, what is operating profit? Operating profit, as the word goes, is nothing but profit from the core operations of the business. This includes revenue, total revenue or total income minus expenses that are associated with the company's core operations. These expenses may include raw material cost, employee compensation expenses. It may may include selling, general and administrative expenses, and so forth. Now, one thing to remember here is that we do not deduct interest expenses and taxes from revenue to come at operating profit or operating profit margin. And the reason is that interest expenses and tax expenses do not comprise part of the company's core operations. So operating profit is simply revenue minus the expenses associated with the core operations of the company. And the operating profit margin is simply operating profit divided by revenue. We want this number, that is operating profit margin, to be increasing every quarter, as it shows that the company is successfully controlling its costs. So let's take an example. The perfect example of companies facing pressure on operating margin since December 2020 are IT companies. Now, within IT companies, let's take an example of Larsen & Toubro Infotech, LTI. As you can see here, Larsen & Toubro Infotech operating profit margin, or PBIT, profit before interest and taxes, was 22.32% in December 2020. Now, since then, from December 2020 till today, the operating profit margin has been reducing every quarter, and the operating profit margin, PBIT margin, in the most recent quarter fell to 18.61%. So from a high of 22% to a low of 18%, the operating profit margin has been reducing. And why is that happening? Let's take a look at the most recent quarterly report of LTI. So on page number 10 of LTI's most recent quarterly report, which is the report belonging to Q1 of FY22, you can notice that the attrition percentage, now attrition is nothing but the number of employees leaving the company. Attrition percentage has increased from 15.2% in Q1 of previous year to 23.8% in the most recent quarter. So from 15 to 24% approximately, the attrition has increased. And not surprisingly, an increase in attrition should lead to increased employee compensation costs, because the company wants to retain these employees. So what it would do is it would increase the compensation that it pays to these employees so that they would stay in the company. Now, to understand this, let's look at the quarterly income statement of the company. So in the quarterly income statement of LTI, you would notice that the company's employee benefit expenses increased from 2,208 crores in June quarter of previous year to 2,872 crores approximately in the June quarter of this year. So the company is paying more compensation to its employees because the attrition has increased. So this way, by going through an earnings report, or specifically quarterly earnings report, an investor would understand why the operating profit of the company is reducing, why the operating profit margin of the company is reducing, and he or she can come to a conclusion about the performance of the company. Another important figure that I like to track is interest expenses. Now, what happens is those companies that have high debt, that have high leverage, they tend to report higher interest expenses. And if the interest expenses are too high, then what tends to happen is that the net profit reduces. And as investors, we don't want interest expenses to be too high as a percentage of revenue. As an example, let's take a look at GMR Infrastructure's quarterly income statement. And remember, GMR Infra is into the operations of airports throughout India. So on Tickertape's website, on GMR Infra's income statement, quarterly income statement, you would notice that interest comprises as much as 31% of the total revenues of the company. Why is that? That's because the total long-term debt of the company is at 24,500 crores. And if you see, the equity of the company is only about 2,000 crores. So the long-term debt as a percentage of equities is about 12x or 1200%. Now, let's take this into a little more detail. In the investor presentation of the company of the most recent quarter, which you will find on Tickertape's website, you would notice on page number 33 that the interest and finance charges this quarter have actually increased from 447 crores in Q1 of last year to 517 crores in this most recent quarter. Now, again, if you notice, the company's EBITDA, or earnings before interest, taxes, depreciation and amortization, is actually positive. So the company's operating profit is positive. The company's operating profit margin is high at 42%, which means that airports are highly lucrative businesses. But because the company has very high interest expenses, it is actually losing money at the net profit level. Now, on the company's earnings call transcript dated July 2022, which you will find on the company's website, on page number 13, you would read that the analyst actually asked this question to the management that, hey, why is the debt constantly increasing even quarter to quarter? And the management basically says that the air traffic is increasing and we are confident that we'll be able to pay our higher interest expenses in the next 2 years through the increased cash that we'll be generating from the airports. Now, we may or may not believe the management on face value, but if you ask me, I'm a little bit cautious on this front. If the interest expenses are higher, then until I see some development, some progress on reducing interest expenses or reducing debt, I would not see this development as positive. Now, the final figure that I tend to look at is the bottom bottom line. Bottom line is nothing but the net profit of the company. It is derived at after deducting our operational expenses, which are employee compensation expenses, raw material costs, selling, general and administrative expenses, other expenses such as stationery or audit costs. And after that, we also deduct the interest expenses and taxes or other one-time expenses from the revenue to arrive at our final bottom line, which is the net profit. Now, in order to increase the net profit, the company may either increase the revenues while controlling costs, or if the revenues are not increasing, then the company may find some approach to reduce the cost. Now, as we saw in the GMR's case, though the company may be profitable at the operating profit level, it is not necessary that the company may be profitable at the net profit level as well. If the net profit is negative but the operating profit is positive, then it may ask ourselves, why is this happening? Is it because of abnormal tax payments, or is it because of high interest costs, or is it because of one-time extraordinary expenses? If it's because of the extraordinary expenses, then which are these expenses and are they likely to repeat in future or not? And finally, it may help to compare the company's quarterly performance with broader macroeconomic trends such as inflation and interest rate. It may also help to compare quarterly statements with industry dynamics. Ask whether the competition is increasing or not. It may help to compare with government regulations as well. Is the import of a critical raw material going to be banned in near future, and more. If you like this video, then do check out our previous videos on how to read an annual report or how to understand a company's financials in depth. Until next time.